A balance sheet provides a snapshot of a company's financial position. It summarizes three key components: assets, liabilities, and shareholders' equity. It is a critical tool for investors because it helps them to.
Hello, welcome to the Nigerian Investors podcast, the unofficial podcast that tracks and reports on the activities of the Nigerian boss. My name is Mudi, and with my colleague Aye, we will be hosting this podcast. TNI podcast is dedicated to stimulating a renewed enthusiasm among the general population with regard to the activities of the Nigerian Stock Exchange. Ultimately, the goal of TNI is to see that many Nigerians from all walks of life, both at home and in the diasporas, become active participants on the floor of the Nigerian Stock Exchange. Before we go further, we would like to place on record TNI podcast is solely for educational purposes and not a replacement for professional financial advice. Let's begin. Welcome back to the Nigerian Investors podcast, the podcast where we break down investing concepts in a way that is easy to understand and apply. I am Moody, and today we're diving into one of the most important financial statements, the balance sheet. If you've ever wondered how to assess a company's financial health at a glance, then this episode is for you. And as always, joining me is my co-host, Aye. Aye, how is it going?
Hey Moody, I'm doing great. Super excited about today's topic because the balance sheet is fundamental for making smart investment decisions.
Fantastic. Let's get right into it, Aye. Can you start by explaining what exactly is a balance sheet?
Absolutely. A balance sheet provides a snapshot of a company's financial position at a specific point in time. And what we mean by that is, unlike the income statement and other statements that basically captures a company's financial health over a period of time, a balance sheet is basically at that moment where the balance sheet was prepared. Let's say 31st of December being the end of the year, the financial health of the company at that specific moment. That's what we mean by that. Now, it summarizes three key components. We have the assets, which is basically what the company owns in total. We have liabilities, which is basically what the company owes. And then we have shareholders' equity, which is the owner's claim on the company's assets after all debts and all liabilities have been paid. It is a critical tool for investors because it helps them to understand the financial stability, liquidity, and overall health of a company.
Exactly. Let's start with assets. Assets are resources a company owns that provide future economic benefits. These are typically divided into two categories: the current assets and the non current assets. Aye, can you break down for us?
Sure, I can. So, by current assets, what we mean is we're referring to the short term assets expected to be converted to cash or used up within a year. Just to provide a little bit of context, they are often referred to as operating assets because they are the assets that are used in the company's day to day operations within the year. Examples include cash, accounts receivable, which is basically money that is owed to the company by its customers or clients, and inventory. We also have what we call non-current assets or long-term assets, right? They are basically assets that will be used beyond just 1 year, right? So unlike the current assets that are used up within a year, the non-current assets will be used over a period that is extending past a year, right? And some of these include things like property, plant, and equipment, or PP&E, as we call them. We also have patents, trademarks, and goodwill. These assets help companies to generate revenue over the long term.
Great explanation. Now, let's talk about liabilities. Liabilities represent a company's obligations, money it owes to others. Just like assets, liabilities are categorized into current liabilities and non-current liabilities. I break those down for us.
Of course, Budi, of course. So, by current liabilities, similar to current assets, current liabilities are short term obligations that are due within a year, right? So, basically, these are monies that the company owes that it is going to basically be obligated to satisfy within a period of a year. And such assets include, or rather, the items you will see under the current liabilities include accounts payable, which is basically the opposite of accounts receivable, right? Accounts payable is money that the company owes to its suppliers, right? And it has to pay within a 1 year period. We also have short term loans that the company can borrow money, right? Short term borrowings that the company can make, and they will have to be settled within a year. And we also have accrued expenses. And similar to the assets, we also have what we call non-current liabilities, right? That are basically long-term debts or long-term liabilities that extend beyond a period of a year, right? And items under this include long-term loans, similar to short-term loans, but the difference here being that they would extend. These are debts that the company has incurred that will extend beyond the year. We also have bonds, right, and deferred tax liabilities.
Thank you so much. Now let's discuss the third component, shareholders' equity. We always hear this all the time. Equity is not growing. Equity is this. Equity is that. In fact, if you guys recollect the very first interview we had, the person when he interviewed, he said one of the red flags that he looks for in a company is if equity is shrinking, if it's not growing. So, what is equity? Aye is going to help us with that. So, equity represents what is left for the owners after all liabilities are deducted from assets. If you've been following us so far, you understand that assets are simply what the company owns, and liabilities are more like a debt that the company owes others. So if you subtract the liabilities, the debt from what the company owns, then whatever that is left is what we refer to as equity. I.e., what are the key components of shareholders' equity?
Great question, Moody. So shareholders' equity includes, first of all, we have common stock, right? So this is the value of shares issued to investors, usually, especially when the company is being founded or the company raises additional funding, right? The value of those shares are grouped under a item under shareholders' equity called common stock, right? And that's just one of the things that make up shareholders' equity. We also have retained earnings. So when a company makes profits for for itself, right? When a company makes profit, basically, it pays out some of them or sometimes all of it, but sometimes it retains some of those profits. So profits that the company retains and has reinvested instead of distributing as dividends is what we call the retained earnings account under shareholders' equity. We also have additional paid-in capital, which is extra money investors pay over the nominal value of shares. So yeah, that's a very it can get a bit technical for some investors to understand this, but we have nominal value of shares. Often shares are valued at 50 kobo. Some companies value it at different ranges, but 50 kobo is the most common nominal value for shares. So basically, every share of a company valued at 50 kobo is what we would categorize as the common stock, right? Or the common stock value of shares that have been issued. Then the additional amount paid beyond that 50 kobo is now what falls into the additional paid in capital side. But a simplified way of looking at it is all the amounts invested in the company by the shareholders, right? All the money that the investors have given to the company or invested in the company shows up in the shareholders' equity. Then all the monies that the company did not distribute out from its profits to shareholders, but rather reinvested in itself, falls into the retained earnings account, and combined, these two sums make up shareholders' equity. You will often see other items too under it depending on the company, but these are the most important ones. Yeah.
And of course, this all ties back to the fundamental balance sheet equation. Assets is equal to liabilities plus shareholders' equity. This equation must always balance. Hence the name balance sheet. Aye, what do you have to say about that?
Exactly, Moody. So Understanding the balance sheet is very, very crucial for investors because it helps investors to understand and assess number one, the liquidity of the company. How easily can a company pay its short-term obligations? Remember, we said this that a company has short-term liabilities or short-term obligations, and it also has short-term assets or short-term accounts that it has on its balance sheet, and it needs to be able to use those assets to basically take care of those liabilities. So a company with a very healthy liquidity ratio will not find itself always in need of borrowing extra money to basically pay off some of these short-term obligations. Yeah, so it just stays financially healthy. It also helps us to assess the company's solvency, right? That is basically a company's ability to meet its long-term debts, and like we said, we also have long-term obligations or long-term liabilities on the company's balance sheet. But we also have long-term assets, right? And these assets are generating revenue. So a company might need to pay down or pay the obligations on its long-term debt. And when you assess a company's balance sheet, that helps you figure that out, right? It also helps you figure out the overall financial health of the company, whether the company is financially stable and growing or not, right? Monitoring how the company's balance sheet items, the assets, the liabilities, and the shareholders' equity is growing over time. And if the company is able to maintain a healthy balance between these different items, it's very, very good in knowing if a company is financially healthy or not.
That is spot on, Aye. Thank you so much for that. And a pro tip for our listeners: never analyze a balance sheet in isolation. Always review it alongside the income statement and cash flow statement for a complete picture of a company's financial health. Final thought and takeaway, Aye.
Absolutely, Bonnie, absolutely. So also, it's important to compare balance sheet over a period of time to see that growth, obviously. So, for example, you want to compare last year, that's 2024's balance sheet as of the ending of the year against 2023 as of the ending of the year to see any growth or any trends. It's also important to compare it against competitor companies in the same industry, not against companies in different industries, because the configuration in the balance sheet will be mostly similar within the same industry. So you don't want to go and compare a Dangote cement against a Fitson or a Zenith Bank, right? That's not going to be a very, very fair comparison,
Yeah,
right?
that's
So because trends
yeah.
matter a lot. Yeah.
Mhm. Yeah, that's true. Yeah, because you'll be led astray if you do that. Well said, Aye. So to all our listeners, next time you look at a company's balance sheet, you will know exactly what to look for. And that's it for today's episode of the Nigerian Investor. If you found this helpful, don't forget to subscribe and, more importantly, leave a review and share this episode with a friend.
And follow us on all our social media platforms for more investing insights. So meet again. See you next time.
Thank you for listening to another episode of the favorite podcast that brings insight to the Nigerian stock market. We hope you enjoyed today's episode. To get more episodes like this, follow us on YouTube, Twitter, Facebook, Instagram, TikTok, Amazon Music, Apple Podcasts, Spotify Podcasts, as well as on our website. All this information is available in the show note below this episode. Until we bring you another episode your way next week. Bye for now. TNI podcast is executive produced by Mudi. This episode was edited by Rona at Rock Quarry Village Studio.